For more on today's top line story and our featured guest, we're now joined by Dana Avigdor. She's portfolio manager and head of trading at Barometer Capital Management. Dana, good to be with you. Thank you for coming in.
Catherine, thank you.
I want to first get your take on what we saw, because it was an interesting slide just after that 2 o'clock time period in terms of these program trades. What are you seeing going on right now? You said during the commercial break that there were more earlier today.
Yeah. Well, I was going to say this when we were if we're talking about the market in general, from a trading perspective, it did feel heavy. It has been feeling heavy. We've had 65 days of no 1% moves in the S&P, for example. That goes way back, and the last few days has been a very tight range, 5 to 7, 10 points, and it started to feel heavy. We've seen some large sell programs, and we see this various ways. You see the upticks versus downticks, and just as I left to come here, it was one of the largest of 2017. It counted 1,100 names, and that maybe coincides with that S&P ESH7 mini future. Sometimes it's a balance thing. Sometimes the hedging, you usually see these trades in a couple of markets, especially when it comes to the futures, where somebody's hedging, but somebody takes the other side, and so maybe you see it come back to the equity markets. Maybe somebody's shorted an ETF and had to do something on the equity side, or vice versa. So anytime you see a trade that's this size, you tend to see it in two separate markets: futures, cash futures.
Right, because there's another side to the trade.
There's another side.
Take that trade and maybe hedge that trade out as well.
Yeah, because the broker community, the banks are not in the business of taking a position, unless, of course, it's their wealth management or position trader situation. But as a facilitator of client flow, they're not in a business of taking a position, so they always hedge it out.
But I just want to be clear for our viewers on this, which is you saw a large program trade. So a big firm might decide to say, I want to sell 1,100 names, as you said. 1,100 names is a lot of names to want to sell. That's the program trade, a program trade, but we also saw was a program trade selling futures. So protecting the potential downside. So two different strategies going on here.
Yeah, no, so what could happen is you could have the, I'm speculating, of course, I'm just playing out a scenario. You could have asset manager selling futures, let's say, to a dealer who's now long, who's now selling equities, or laying out his risk to another client who's now buying the futures. It could be a type of a risk arb or a ETF arb. All I'm trying to say is that sometimes and often in today's market structure and in the way portfolio and all the different products and types of asset management that we have, and the way hedging has become commonplace, you tend to see these trades in two markets. You tend to see the other side of the trade.
Right.
And it's a sell side because the other side is a buyer.
I think the one reason why I'm focused on this for just a moment is because a lot of people will remember the flash crash a couple of years ago, when that was a sell of futures as well. That was a very, very large sell order from a firm that I actually used to cover. But that's what they always did as regular business to protect their positions, right? But because it was a nervous market, I think we had the high-frequency traders jump onto that, the electronic trading jump onto that, and therefore there was maybe a little bit of a moment where there was a bit of a spiral. So that's why I'm trying to have an understanding about what's going on. And this is just one or two or however many money managers saying, look, I'm going to take some risk off the table.
100%, but you're touching on a subject that's very dear to my heart, and I'll just say this, that the way the market structure is and the electronization and the technology and where we've gotten with trading, it's fantastic. We can do so many great things and trade away our situations so everything is priced properly. But the flip side of that is that things price really fast. Errors cost a lot of money, and that's what you had with a flash crash. If somebody puts out an order, especially electronically, and just lets it go in the market, and it's not done properly, not watched properly, not handled properly, it can create havoc.
So we're talking about a couple other money managers, not you and your team. Let me get your team's views right now. We're going to get into the top line, of course, which is the railroads. But I would just, because we talked about this kind of broader market conversation, what are you thinking right now?
So like I said, market feels heavy, but does not feel bearish. you can sense that there is a bit of a better for sale. You can see that the bids are not as aggressive as, say, they used to be 2-3 weeks ago. But you're not seeing, you're not seeing the bid strong, but the marginal seller doesn't have as much of a robust bid to go to. And so the market has a slower range. Some could say it's consolidating. It'll break up or down. And so we've gone a long way since Mr. Trump was elected, a lot of moving parts. And, it's only fair to have people question, where are we going next? We need the earnings to catch up to the prices a little bit so that the PEs can moderate.
Right.
We at Barometer, from the stuff that we look at, we're positive. We think that the flows are equity friendly. From a macro perspective, macroeconomic perspective, rates, regulation is a big deal. One of our senior PMs went to Washington for a Strategas conference 2 weeks ago, and on regulation, this is what they said. Regulation over the last 8 years, it was 392 regulations with over $100 million cost. Strategas prices it at 80 beeps to GDP. So regulation is a hugely big, costly, non-productive bearing on growth. So this friendlier government is a big deal. And our internal indicators, which we're very disciplined to, are not showing any deterioration. So even if the market feels heavy from a trading perspective, it actually can provide opportunities if the underlying themes are working.